Good evening. My name is Zikaillah Diramia, and I'm going to present my critical review of the paper titled The Global Financial Crisis and the Capital Structure of Firms. Was the impact more severe among CMS and the non-listed firms? This paper was published in the Journal of Corporate Finance in 2020, authored by Demirgüç-Kunt and his teammate. Sorry for the pronunciation. Okay, so this research examines how leverage changed the post-global financial crisis across the CMAs, large non-listed firms, and the listed companies. In this research, they define leverage as the use of the borrowed capital or debt by firms to finance their operations and investment, and leverage influence of firms' financial risks, profitability, and stability. So the reason why the authors talk or discuss about the leverage is because at 2008 global financial crisis, all of the firms, SMEs, large non-listed firms, and the listed companies are exposed to vulnerability in the firm's capital structure, and all of those leading to widespread deleveraging. Because during the crisis, all of the firms faced restricted access to credit and forcing them to adjust their capital structure. Specifically for SMEs and the non-listed firms, which rely heavily on the bank financing, they were exposed to more vulnerability compared to listed firms that could access capital market by being IPO or selling stocks. Therefore, this research paper have three research questions. The first one is how did firms adjust their leverage level post-crisis? And the second one is did non-listed firms, such as SMEs and the non-listed firms, small non-listed firms, suffer more than the listed firms? And the third one is how did country-specific financial conditions shape those adjustments? And this objective of the research is to provide empirical research by analyzing 276,000 firm-level data across 75 countries within 2004 up to 2011. And mainly in this research, they talk about trade-off theory that proposed by Pharma and French in 2002. And this theory suggests that firms use the financing because of its tax benefit. But they also propose that the financing should be balanced against the risk of the financial distress. And this theory supports the statement of two statements. The first one is the firms actively manage their debt level because of or based on the risk exposure. And the second one is how firms reduce leverage in post-crisis to avoid default, which is one of type of the financial distress. And the second theory explained or discussed in this research paper is pecking order theory proposed by Myers and Majluf in 1984, and it suggests that firms prefer using internal funds first, and then debt, and then issues equity only as the last resort. And this theory supports the statement of two statements for this research. Is the first one is how listed firms access equity market as an alternative to the bank loans if the banks were restricted in the crisis. And the non-listed firms were forced to deleverage more because of the fewer options, because they could not access the capital market and they have restriction on the bank loans, therefore they have to deleverage. And the third theory or a discussion that being discussed in this research paper is a financial constraint model proposed by the same author, but in 1990, and it suggests that a firm's ability to raise debts really depends on the financial market conditions and the legal institution. And this model supports the same two segments. The firms in the countries with a weak financial system experience greater leveragings, and how external constraint really shapes the leverage decision between those firms. And the fourth, the fourth one is the capital markets spare tire hypothesis proposed by Levin, Lin, and C in 2015 that suggests that listed firms can use capital market as the alternative financing source when bank lending is restricted. So it's similar to the previous theory that this hypothesis support the statement that the listed firms maintain higher leverage levels across post-crisis, and the non-listed firms, which relied on the bank loans, face greater financial stress. So how those theories shape the research models? So those theories help the author shape the research model by 2 points, 2 key points. The first one is the previous research proposed that leverage adjust based on the firm type, listed and non-listed, and the counter-specific financial condition. And the second one is the empirical model includes variables reflecting those theoretical influence such as firm size, access to equity, market, and the institutional quality. So, if they combine the previous research and the empirical model, it proposed that why different firms adjust leverage differently after the crisis. So that's the summary of the literature review. And the model of this research is to analyze the firm leverage evolved post 2008 financial crisis with a sampling of 276 firms across the 75 countries with the time frame of 2004 up until 2011 with the variables of total debt per asset, the long-term debt per asset, and long-term debt per total debt. So all of these variables will be used as empirical analysis using the firm level data. And the key findings is that the leverage declined globally in the crisis, even in the countries without banking crisis. So between those time frame, the leverage of the firms, even though they have not have a banking crisis, is still globally decline for their leverage. And for the non-listed firms, including the SMEs, experience the most significant leverage or leverage reduction. The listed firms could maintain access to capital market. It's proving the spare tire effects, and the countries with a weak legal system and credit information had a greater deleveraging. So it also proved the financial constraint model that mentioned previously. So, by assuming that leverage adjustment post-crisis were primarily driven by financial constraint and firm-specific factors, and we also assumes that listed and non-listed firms operate in a different financing environment, and all firms within a country face similar financial condition. This research proved that a firm with a weaker financial positions, they have deleverage more aggressively and more deleverage, and further are not influenced or could not be influenced by government intervention. And the listed firms could maintain higher leverage due to the access to the capital market, but for as the non-listed firms, they face deleveraging because they could not access the capital market and only heavily rely on the bank loans because they have no other option rather than loans. And there are also significant cross-country differences proved by this research that there are differences in the deleveraging levels based on the legal system and the financial market development. And I do think that this research is really comprehensive because they analyze around 276,000 firms across the 75 countries. So it's kind of broadly applicable and reliable for this research, especially if we want to analyze the global impact of the crisis. So I do think that this research is really applicable and really broadly applicable. And this research, they said that it's expand on the Levine's research about capital market or spare tire hypothesis that confirmed that listed firm rely on the capital market as a spare tire during a financial crisis. So other than they have really broadly applicable research, they also explain or further proof about the capital markets pair hypothesis about the listed firms. So it could be say that it could be wait, okay. Yeah, it could be confirms that listed firms is really influence. They have other option rather than bank loans, which is capital market. So they have a spare tire other than bank loans. And this research also directly compared between listed firms, non-listed firms, and SMEs, unlike the previous research that do not include SMEs, that providing these holistic views of leverage adjustments. So they add more scope between listed firms, non-listed firms, and SMEs. So this is one of the strength of this research. And they also expand more on their previous research about financial constraint model by strengthening the argument that financial constraints significantly impact leverage decision, particularly in a weaker financial market. And they also expand those model by analyzing between cross country and cross firms within the listed, non-listed, and SMEs firms. However, I do think that this research have a lot of things to unpack for. Maybe this research already have a lot of data in global, but I do think there are other hidden factors that maybe just like could influence or affect changes in leverage, not just like global crisis. Okay, global crisis could influence leverage cross country, cross firms, but I think there are they didn't research or analyze other hidden factors like the management decision, the industry specific shocks or regulatory changes within those crises that they could not explicitly model. And this study does not account for firms to went bankrupt or exited the dataset. So, for example, if before 2008 they have maybe a good leverage or they have leverage, but after 28 crisis they go to bankrupt, those firms didn't be didn't be included in the dataset. So I do think that they don't oversee how the crisis really affect how companies or firms that previously have leverage and after crisis or post crisis have bankrupts or exit datasets. So it's really underestimating the true impact of the leverage, the crisis in the leverage on the leverage. And how this research help the real world corporate in their financial decisions. So, based on this research findings, the SMEs and non-listed firms have, as in this real world, have to be more careful, especially in the financial crisis when doing leverage decision making, because they have to realize that they have to realize, sorry, they have to realize that they have no spare tire compared to listed firms because they have no access to capital market. They have to be careful when they got in a crisis, especially if they heavily relies on the bank loans. As for the listed firms, well, the decision making toward leverage is easier because they have a spare tire or the access to capital market. So those listed firms, because they have a spare tire, they could adjust their capital structure more efficiently because they have bank loans and they have capital market and their equity. And both firms, SMEs, non-listed and listed firms, will be influenced honestly by the institutional factors, such as how those firms located in a country with a better legal system, stronger investor protection, and deeper financial markets. So this research paper could help the firms, all of the firms mentioned above, about realizing where they're being located. Are they being located in the country with better or worse legal system, a stronger or weaker investor protection, or deeper or not deeper financial market? Because all of these institutional factors really influence could influence the how leverage or other policy protect them from the crisis. So they those essential factor could help them or not help them um, experience or protect from the reduction in leverage. And other empirical evidence and the case study on leverage is about global financial crisis. And this research phenomena mainly focus on how the leverage evolved before and after the global financial crisis in 2008. And this firm leverage and the use of the long-term declined significantly after 2008. So between 2004 2008 and 2008 to 2011, there are um, a significantly decline long-term the use of the long-term debt and the firm leverage. So it also really heavily impacted the SMEs and non-listed firms. And this also have the empirical evidence based on the empirical evidence of the regional comparison about how the US and Europe have moderate deleveragings because they have a better system compared to the other countries that such as Latin America and Africa, for example. So the US and the Europe have moderate deleveragings because they have alternative financing option, such as the capital market, the bonds market. It's the same. Sorry. As for the Latin America and the Africa, they have severe credit shortage led to higher business failures of deleveragings. And for East Asia, the China's, Japan, and South Korea, they maintain higher leverage, which is really shocking. because because here's the point. It's because the East Asia's countries is really supported by the bank liquidity. So their government help the firms located in the China's, Japan, South Korea to help them against the crisis and the leveraging by the banking liquidity policy. So there are regional or cross-country comparison between this research paper, and this could be the case studies, the real or empirical evidence and case study on the leverage. And the conclusion, like the recommendation, the key insight for the further research, I do think that the first research could be like long-term impact of the leveraging on the firm's performance. So because the previous research or this research talk or analyzed the like 2008 up to 2011, it's just like short term, like 3 years, uh, 3 years range of times. And I do think it's really recommended to have for the further research to research about the long-term impacts because this research does not really fully address the leveragings in the long run, and it's remain unclear, at least for me, whether firms that reduce their leverage dramatically end up with better financial stability or they just goes to bankruptcy. We don't know. I don't know. And this further research of the long-term impact of the leveraging on the firm performance aims to learn how long-term trade-off can help firms and investors assess whether aggressive deleveraging is beneficial over an extended period. So, for other firms that that got a deleveraging in the crisis, is it really a trade-off, or it could really help the firms to survive in the long term? And I think it's really what is it? It's really great. Not great. It's really dramatic. Yes. Uh, we also research about sectoral differences in the leverage strategies because this research provide the evidence about the wide range of firms and countries. I do think that they didn't talk enough about the sectoral differences because there's a lot of companies per country, but they did not cluster those firms into sectoral analysis. And I hope By researching about sectoral differences in the leverage strategies, this could help the researcher to learn about whether there are differences between the sectoral that influence the firm leverage and their capital structure strategy. And the practical implication of this research paper using the advanced financial concept is that, okay, for the non-listed, let's focus on the non-listed and the SMEs first. So, the practical implication for those firms, as the non-listed firms and the SMEs, is that they could explore the non-traditional financing source because they relies heavily on the bank loans, but they also have no access to capital market. So I don't think they um could rely on the restrictive bank's covenants to make themselves more disciplined, or they could create, a closer relationship with banks so they could become financing partnership instead of just relies on loans. Well, additionally, or specifically for the SMS, they could explore others, not technology, other financing like fintech, like peer-to-peer lending and crowdfunding. If their SM is not or there isn't qualified enough to loan bigger amount to banks, and they could also provide the asset-based lending as other way to increase leverage if their equity isn't enough. As for the listed firms, the practical implication from this research is they're already doing great. They could doing more better, doing better by regularly recalibrating the debt equity ratio to maintain the optimal way okay, doing the optimal capital and do the trade-off between tax shield benefit and the financial distress. And these are the reference use for the research as and for the analysis for the research paper. Yeah. Thank you.